just going to start. Hello, everyone. Good evening. I'm Karen Tucker, CEO and board member at the Churchill Club. Welcome to the 2013 VC Roundtable. I'd like to welcome our rock star panel, starting with Andrew Chung from Khosla Ventures, Jeff Clavier from SoftTech VC, John Lilly from Greylock, Jonathan MacQuitty from Abingworth Life Science, and Pete Sonsini from NEA, and our moderator, Steve Bengston from PwC. Thank you all very much for being here tonight. And I also want to acknowledge our wonderful sponsors. Thank you, Microsoft, especially Daniel Lewin and Doug Free. Thanks also to Womble Carlyle, especially Mike Giancarella. You can learn more about Womble in particular at their table outside the auditorium. But your support and leadership means a lot, so please join me in thanking our sponsors. A brief introduction for our new guests. Churchill Club is Silicon Valley's premier independent business and technology forum since 1985. We've been convening unique Silicon Valley-style conversations where people can convene with each other and connect with ideas as well. The theme that guides us every day is to encourage innovation, economic growth, and societal benefit. And we do this through the up to 40 programs or so that we present each year. And we are a member-supported nonprofit, and if you have an interest in joining us, we would welcome you to look into that. We have an outstanding set of programs coming up, starting with Disrupt or Be Disrupted with the leaders of Airbnb, Expensify, and Pebble on June 12. Revolutions in the Making, which is a close look at the most economically disruptive technologies according to a recent McKinsey report, and a breakfast program about what makes standout company performers different on June 26. And the McKinsey program is on June 17. So 3 more programs before the month is out. And be sure to keep an eye on our website or get on the mailing list because new programs are coming out all the time. If you're tweeting tonight, please use the hashtag Churchill Club, and you'll also find other Twitter codes in your printed programs. And now let me introduce our moderator, Steve Bengston. Steve is director of the Emerging Company Services Group at PwC, and in that regard, he and his group act as mentor capitalists for young, high-potential companies. He's also past chair and a current member of the board of directors of the Churchill Club, and we're extremely honored to invite him back to our stage to lead this discussion. Please give a warm welcome to Steve Bengston.
Thanks, Karen, and thanks everyone for joining us this evening. This quick format, I'm going to give a brief overview of the venture industry, and then each of our panelists are going to introduce themselves, their fund, and chat about anything they wish to. And then I'll start firing questions for a while. We're going to flip to audience questions around 8 o'clock, so you can start thinking about what your questions are. And I think everyone is able to stay afterwards if you've got something you want to chat with them privately, and we'll have a hard stop around 8:30. Start with just a quick overview to level set on the venture industry. To give a historical perspective, the venture industry is roughly 50 years old, 50 years old. It started in Boston. So Boston had about 100% market share for a few years. Then it migrated to Silicon Valley, and Silicon Valley took over the #1 spot about 30 years ago. And it's slowly built its lead ever since. So to fast forward to today, Silicon Valley gets about 40% of the venture investments in the U.S., followed by Boston, New York, and Southern California broadly, each of which get about 10%. So about 3 times as big here as anywhere else in the U.S., and the top 4 markets get about 70% of the total. On a global basis, given another perspective, about a third of the venture capital invested in the world gets invested in California. About a third gets invested in the rest of the U.S., and about a third gets invested in the rest of the world. So you can see there's a real dominance in the U.S., a real dominance in California for now. The level of investment has been amazingly volatile over the years. Starting in the 80s, there was only about $3 billion a year that got invested in the entire U.S. That probably represents roughly what this panel invests a year now. And it was very, very stagnant. In the 90s, there was a lot of variation. It started again about $3 billion, and by the end of the 90s, it was around $50 billion. Then 2000 was the height of the bubble. It was about $100 billion. And by the end of the decade, it was down to about $20 billion. And for the past 10 years, it's hovered in the 20 to 30 billion range. It was about 27 billion last year, 2012. And based on the first quarter, it looks like we're headed toward the low 20 billion number this year. So a lot of money by anyone's standards. The top 4 industries for the past handful of years have been roughly in order: software, which has been number 1 almost every year, and Andreessen's line about software slowly eating the world seems to be coming true. Its market share seems to be increasing each year. But the other 3 are biotech, clean tech, and medical devices, which was interesting because all 3 of those have some pretty substantial issues, which we'll chat about on the panel tonight. For the first 40 years of venture business, it was an amazing profit machine. It returned about 20% a year for many years to the LPs. It's well publicized. The last 10 years have been roughly 0. Much different environment. And now VC fundraising is very difficult for anyone that's not on our stage tonight. The exits have really changed over the years. For the first 34 years, most of the exits were IPOs. That was the gold standard. That's what people wanted to do. And IPOs were much more abundant than M&A. That completely flipped about 10 or 15 years ago, where today there's about 50 to 70 venture-backed IPOs in the U.S. versus about 400 to 500 M&A events. So complete dominance of the M&A world now, and not likely to change anytime soon. Some of the big benefits of the venture industry: it's created a lot of jobs. So especially in this administration, jobs have been a big story of the venture industry. A huge percentage of the tech jobs in America, something like 20%, have been with venture-backed companies. Most of the high-tech companies in the U.S. had venture backing, and the venture capital industry in the U.S. is the envy of the world. It used to be very local, and now it's gotten very international. Most VCs 20 years ago drove to almost all their deals. That was almost a rite of passage. It was almost, that was like just what was done. Whereas now there's many VCs that fly to most of their deals, and many times they fly outside the country they're in. So in a quick summary, the venture industry is in a bit of disequilibrium right now. It cannot really stay the way it is. It's not, LPs are not likely to put up with an industry at this scale that returns 0% for another 10 years. So something's going to change, but the destination and the path there is unclear, and we'll undoubtedly touch on that. So with that, I'm going to just kind of each of the panels are going to introduce themselves, talk a little bit about their background, their fund, and any other topics they want to bring up. And then I'll start firing away questions, and we'll start with Andrew Chung with Khosla.
Good evening, everyone. Thanks for spending time with us tonight. I'm one of the 7 investment partners at Khosla. We manage about $3 billion of committed capital, investing out of 2 different funds. We have an early stage seed fund that's about a $350 million vehicle, as well as a late-stage main fund. The way that we split up our funds is really important and core to our philosophy, which is we like to take really big bets. The seed fund almost exclusively is around experiments, really large experiments that can be done across any sector, as long as the end result is potentially transformative, game-changing, and industry-toppling. And so we're also able to cross-invest among funds. So for the experiments that work in the seed fund, we've got a $1 billion vehicle that can take it hopefully all the way to a successful IPO or exit. Firm has about 150 plus investments that span a broad set of sectors. That includes about half in the sustainability area, and then the other half in information technology and med tech. And myself, I would say that I'm a bit of the schizophrenic VC, but perhaps if you look at my bio versus some of the other gentlemen on stage, you'll find that I've dipped my toe into a lot of different waters. I'm on the boards of 9 companies that span the world's largest online community for readers and writers in Wattpad, to a company that has developed a technology to convert waste gas into fuels and chemicals in LanzaTech, to a next generation engine technology that is 50% more fuel efficient for 20% lower cost. And then with Mr. MacQuitty down the road, I also worked with him to help start a genomics company, which is a very exciting one. So for me, the unifying theme of all my investments really is that they are technologies that are a discontinuous leap that generate a type of wave and momentum that really can potentially revolutionize or topple an existing industry. So it's a pleasure to be here tonight, and look forward to your questions.
Thanks, Andrew. Next up is our resident fashion expert, Jeff Clavier with SoftTech VC.
So you can find that shirt on Fab, since many people seem to like the shirt, which we happen to be an investor into. So Jeff Clavier, managing partner of SoftTech VC. The firm has been around for 9 years now. So 9 years ago, back in 2004, I thought that it would be a good idea to back this next generation of consumer internet companies that is now called sort of Web 2.0. And did that with my own money for some time, then raised one of the first micro VC funds back in 2007, and raised one of the largest micro VC funds in 2010. And now everybody and his mother is doing a micro VC fund, which I think shows that it might have been a good idea. We invest about 20 times a year in consumer internet, business-to-business infrastructure, SaaS. We do quite a bit of marketplaces. We have essentially a passion to back entrepreneurs who are obsessed about building really big companies into new markets, whether by disrupting an existing market or creating a new market. And we try and do that, in mostly in the Valley. 10% of our deals are in New York. New York is this sort of interesting suburb of San Francisco that you happen to fly, for 6 hours to. But it's sort of the way we think about it.
We call it the East Bay.
I thought it was East Coast, but okay. Lost in translation. And we do a bit of investments in Canada, most recently, interesting enough, and Boulder. Some companies that you might have heard of, so Fab, Fitbit, Eventbrite, Mint, are some of the close to 150 companies we've backed over the past 9 years. What gets us excited? So even though I was one of the seed investors in Fitbit, it took me about five years to get back to hardware, so the mix of hardware and software. And so those connected commodity objects are pretty interesting to us, so we've done a couple of those recently. We've done quite a bit in education tech in the past year and a half. We're about to do a drone company, which I'm super excited about. And medtech is actually something that we've stayed away from for a long time, and we're starting to look into.
Thanks. Next up is John Lilly with Greylock.
Hi, thanks for coming tonight. So let's see, about Greylock a little bit. So Greylock is one of the firms that started in Boston. So we've been around almost 50 years now. I don't know if that's a feature or a bug, but it means we've learned a lot over a number of funds and have had pretty good staying power. In 2008, we officially moved the headquarters to Silicon Valley, to Sand Hill Road, which is where our office is now. And we're software people, ultimately. We do consumer internet and enterprise software. That's where we live, that's where we stay. We don't get too worked up about other sectors. We try to focus on things that are made of software and bits. So on the enterprise side, we've been very fortunate to be involved in some of the biggest companies over the last few years. Workday was actually started by my partner, Neil Weil. He was a partner at Greylock. And he took it from start to the IPO and to the company it is now. Palo Alto Networks, we helped incubate along with Sequoia. Cloudera is one of our companies. Pure Storage is another one that's an amazing company to watch. So on the enterprise side, we've been very, very fortunate. On the consumer side, likewise, we've been fortunate. LinkedIn, Facebook, Pandora. So my partner David Z and James Slavitt and then Reid Hoffman more recently have been really focused on how do you get interesting global scale network companies. So I'm the new guy coming in, so I joined 2 years ago after running Mozilla for a number of years. I got to Mozilla when we were about 12 people and Firefox had about 5 million users, and then became the CEO after a couple of years and grew it to be about 450 million users worldwide. Since I've been at Greylock, I've invested in Instagram, Tumblr, Dropbox, a new company called MessageMe, and a B2B company called ClearSlide, and an e-commerce company called Citrus Lane. So again, I focus on software, roughly things that nerds like is my zone of influence. My background is I'm an entrepreneur and an engineer and a designer. Most all of us at Greylock have started or run companies at scale, and that's one of the things that we pride ourselves on, is that we've actually been in the seat that most entrepreneurs are in. We've all raised money. We've all felt what it feels like. So that's us.
That's $2 billion exits in like 2 years.
For Tumblr and Instagram? Yeah, well, I was an investor in Instagram for 4 days, so you can't make a living quite like that.
But they still get the credit, though.
But the IRR must have been good.
Yeah, my highlight of my career so far in venture is Dave Swenson from Yale sent me a message. And Dave's one of the founder, the foremost thinkers in how to do institutional endowments. Said this must be a record IRR, and so getting a note like that from Dave is a pretty good deal.
That's very impressive.
Thanks, John. Next up is Jonathan MacQuitty from Abingworth.
So we are very different from everybody else here. We only do life science and biotech. We've been in business since 1973. That's when Abingworth was founded. And although it was founded as a diversified firm, very quickly in the early 80s became focused on life science and biotech. We have about 30 people split between 3 offices. We have an office in London, office in Boston, and I head up the office in Menlo Park on Sand Hill Road. We do 50% of our investing in the US and about 50% ex-US, so we're actually pretty sophisticated from an international point of view. We understand some of the issues associated with that. And we understand a lot of the issues associated with life science investing, and I'm sure we're going to get questions about that. As for myself, I started at Genentech after a PhD and an MBA 31 years ago, so a while ago. I started my own company in 1988. Abingworth, one of the venture capital firms that invested in me. And in 1997, we sold the company very successfully, and I've been a venture capitalist ever since. So, and the same way with you, of the 30 people, most of them have come out of the industry. So, of my colleagues, 4 or 5 of them have been CEOs and entrepreneurs. Some of them have been heads of research. Some have been, CFOs in biotech companies. So we understand the game.
Thanks. And next up is Pete Sonsini with NEA.
Yeah, thank you for being here. It's nice to be here, and comments on NEA that I can just give you the highlights. It's also a global firm that's been in business for actually about 35 years now, so not quite as long as Greylock. And we're investing out of our 14th fund, which is a $2.5 billion fund, so it tends to be on the larger side. And I think what's a little different about NEA is that we have investment expertise really across all of the various different vertical industries, and we will dynamically allocate the capital to the various investment areas, the various vertical industries where we see the most promising opportunities. So instead of having this separate growth fund or early stage fund, China-India fund, we actually have one large fund, and we can allocate the capital to different areas where we see there's the best opportunity based on as we see it. So that's what's a little bit different about how NEA operates. We have 12 general partners, and I'm the co-head of our enterprise software group. This is my 9th year in the venture business. Prior to this, I have a sales and marketing background here in the Silicon Valley. I most recently worked at VMware, where I headed up the OEM sales business development efforts. Earlier than that, I was at HP very early in my career. I started on a sales job and then product management, so kind of sales marketing type background. And so I've done most of my investments have been focused on the enterprise software area, and given the kind of a proliferation of virtualization, I've been very focused on investing in cloud computing, virtualization related areas. It's something that I've known the best and have kind of some of the most instincts. Definitely have strayed where I didn't have instincts, and probably wasn't some of the wisest things to have done. But that's where I'm mostly focused these days. Yeah, I mean, we've had a lot of success over the years that the firm has, and we were also involved with Workday, and very delighted to be involved with that very successful company, and Tableau Software, another company in the enterprise software space that we invested from a very early stage and recently went public. So, there's other sectors where we've been fortunate to have a fair amount of success. So, thanks for being here.
Thanks. We probably have a lot of entrepreneurs in the audience that are either have recently or about to raise money. Could any of you give tips about do's and don'ts of fundraising from their perspective? What works for you, what doesn't, and also a little bit behind the scenes of once you hear the pitch, assuming you like it, you take it to your team and partners, and kind of how the process works. How partnerships think about deals. It might not be obvious to people trying to separate you from your money.
Yeah.
Well, go ahead.
I'm happy to start. I'm sure each one will have a lot of tips on. So for me, the biggest thing for me is whether you make an emotional connection with me that separates you from the legion of other companies that I meet during a day, portfolio fires that I'm fighting, internal firm-related issues that I'm dealing with. What is it about the presentation, whether it's you individually, your business, your opportunity, the change the world type of dynamic that makes a clear emotional connection with me? And as a former performer myself in another life, a lot of times I liken the interaction that you have with VCs in a pitch context, or whether it's in an elevator or across the table in a conference room, as a performance. You're making a performance, and the subject of your performance is this great thing that is the company that you're working on. And so, what are the different tactics? What are the different ways that you can present using the limited time that you have to make a clear emotional connection that appeals to me, that will allow you to separate yourself from the crowd? And a couple of the things that are nuances that I think are important are really being prepared and understanding the firm that you're talking to as well as the individual you're talking to. What are the things they're interested in? What are the things that they tend to care about and really gravitate towards? And then really being prepared from the standpoint of having the right set of messaging and having gone through your pitch with enough different folks to test the different flaws and understand where the gaps might be. But for me, that number one thing really is that emotional connection that makes me remember you at the end of the day and makes me feel that need to come back to you and learn more.
I think the word "be prepared" is the most important in what Andrew said. I'm still amazed after 9 years of doing this and having seen many hundreds of blog posts or suggestions or books about fundraising and pitches and preparation, to see entrepreneurs who haven't done the slightest research around the firm, the partners, the portfolio, and the things that we'll care about when we sort of listen to you and hear you. Also, knowing your ecosystem and the companies which are either competitors, co-competitors, potential channels is very important. There's nothing worse than us mentioning to you 2 or 3 startups that fit on your competitor slide you haven't heard about. And yeah, the most important thing is understand why you're trying to pitch, Andrew or myself or John or Pete, because we all invest in software, but we have different stages, strategies, and to be honest, some companies which are competitive with you that therefore make us disappear from your list of potential prospects. So understanding all that and showing to us that you've spent a lot of time researching the landscape of investors is very important.
So I would say, this is, again, going back over a large number of presentations. People try to come in and pretend that they have a lot more than they have. They've got a management team, and they don't really have a management team, or they have a sales plan, and they don't really have a sales plan. You have to focus on what you have that is really unique and valuable, and concentrate on that. We're not going to expect you to be, a fully fleshed, large operation from day one, so don't try to pretend you are. And so, one of my uncles knows somebody who used to be an accountant, and he's our CFO. It's pathetic. And so, you don't have to have a CFO. You don't need a CFO. We know hundreds of CFOs. You don't need a CFO. So once you come and tell us what it is you have that is really unique that you have, and to your point, what is the competition out there? To give us a really detailed understanding of the bit that you know, why it's important, why you can make a lot of money out of it, why other people can't do it. Talk about that. Be passionate about that, and tell us. And the other thing is, I sit through a lot of presentations that tell me things that, you know, a high schooler reading the Wall Street Journal would know. You know, I mean, social media is important. I mean, God, you know, whatever it is, you know, it's just, you don't have to give us background information. We're not interested. We don't need that. And it's the same. I get endless presentations on how rheumatoid arthritis is an important indication, you know, or diabetes is a growing problem. You know, we don't need that slide, so take that one out, okay? So the other thing I would say perspective-wise is at some point in time, you're going to be selling a product. Let's go in reverse order. 10 years down the road, you're going to be relating to institutional investors on Wall Street. Before that, you're going to be, you know, selling to them. Before that, you're going to be selling a product. Before that, you're going to be selling shares to, you know, Series B investors. Mm-hmm. Before that, you're going to be selling Series A share certificates. Before that, you're going to be selling yourself. So this is all a sales process. And the comments that you've heard up here, when you roll up, the very first thing you're doing is selling yourself. And so I see people, you know, the kinds of preparation that you would do. Okay, if you're a conventional salesman working for HP or IBM or whatever it is, and you're going in to sell to somebody, you'd know what they were interested in. You'd know how your thing would be fit into them. So do the basic homework that any salesman would do, okay? And when you come in, you know, understand what it is that we might be interested in, and remember that your first thing you're going to do is to sell yourself.
Yeah.
That's good. That's pretty good. I mean, I would just concur. I think that was an excellent summary. I don't know, and that's how I look at the world. I would emphasize that with me personally, it's around the you know, the really unique kind of what I call privilege insight that the individual may have into a particular problem. Identifying problems is one thing, but what is it that you've done historically, whether it's something unique about your product,
right.
But really, what is it something you have done or seen historically that gives you some unique insight into some massive unfolding situation? And so, for me personally, that's one thing that I would actually emphasize the most when it comes to particularly the early stage investing. And one little thing that I would add is just that maybe this is you know, something that's a little bit off the main fairway here, but the venture capital community is very much a herd mentality, and a lot of these people, myself, our firm included, is very responsive to how interested the general venture capital community is in a specific deal. And so, you know, there are some subtle hints that you can do to suggest, I mean, without being, of course, you know, misleading, but there's certain subtle suggestions you can do to indicate that your deal is of interest to the rest of Sand Hill Road that can be helpful to you. And you know, I'm not suggesting that you misrepresent anything, but there are those who walk in and
I've got to leave right now because I'm meeting Vinod in about 10 minutes.
Yeah.
I'm sorry, you know.
So that would be an example of maybe a little too obvious, you know,
having dinner with the president.
yeah. Well, that's right. Vinod's pretty busy right now. So. I would just like to emphasize the importance of that, and there are those who walk in and say, you know, hey, I got a term sheet in hand, you know, and it's like, you know, it's just it seems phony. But then there are those who may say something like, you know, actually, I can't meet you at Monday at 11. You know, where are you going to be? Well, I'm going to be on local, but I've got meetings at Monday at 9 o'clock and 10 o'clock in the morning. And that may suggest that maybe you've got other venture capital partnership meetings that you may be going to, which may convey that it's a hot deal. So something I would just say that there's a certain nuance to how you communicate that stuff, and the reality is on Sand Hill Road and other venture firms that we're very responsive to maybe how interested some of our peers are in the business, and that's something that you can manage delicately, but is I think a very important part of the whole thing.
A good salesperson will know how to
get true. That's true. It's all sales.
Exactly.
Theatricality.
I thought I was going to get like 3 or 4 questions in before I got argumentative, but Jeff knows that that's not really who I am. So I think we have a problem in language. I think we talked just now. We talked about performing deals, presenting sales, tricks, techniques. And I'll tell you, like, I haven't invested in anybody because of the pitch. Or the pitch, even pitch, I think, is a crummy word to talk about this, because entrepreneurs who come in are spending 24/7 all the time trying to build an important business. And financing, the more you think about financing as a transaction or an injection of money, like the more you lose the thread on a chance to get somebody who's interested and helpful involved in the business. And so for us, for me, like every investment I've done, I think, is built on the relationship that I've built with entrepreneurs over weeks or months, and very, very, very little to do with the pitch itself. And so I think that, like, going in thinking, I'm going to try to pitch and unlock this thing or get this deal done or get the sale, I think actually misses the point, because you never do that if you're trying to recruit somebody. Like, I'm going to try to trick this VP of marketing into working for me. I'm going to try to sell this VP of marketing into recruiting for me. What you're going to say is, I'm going to go try to find the right person and then convince them that they'd be crazy not to come work here. And so I think that I found that that's the spirit that we need to work in, or that I work in personally. And I find that the more we think about trying to pitch or perform, the less we think about how to collaborate. And I think that a lot of people, especially including everyone up here, I think we fall into this trap of thinking about deals and sales and performances, when what we're really trying to do is figure out how to build the right teams to go
Good
forward.
point. Very good point.
So anyway, so that's my point of view, is like, don't think about the pitch as a pitch, because the pitch, like, it's part of a process, is pretty important.
So it is true and not true. It's very true at your stage.
I was going to go ahead.
Can I?
Yeah.
It is true at the Series B, Series C sort of later stage, which
Series
is where
A. I live in
Series A to some extent, but seed you can't do that, because by definition, by the time you don't have time to build a relationship with the founders, because you get hit many thousand times a year, and you only do X per year. We only do 20. So I agree with you. It would be great to be able to build this relationship, and I think it works really well from B on. A is sort of fence.
We'll
I
fight over the
So
A's.
I think it's both correct. So again, I go back to my sales analogy. You know, the best salespeople. So someone once told me something really, really early in my career, and I've always remembered this. And it said, some academic group, I think it was Harvard, had looked at how many times a salesperson has to contact a customer in order to get a sale. And they looked at multiple industries, and the median number was 7. You have to have 7 interactions before you can get the sale. And then it looked at the average number of times a salesman would meet before they got discouraged, 4. So, they just gave up. And so I think what a good salesman will realize that what you have to do is build a relationship, and that you're not going to you're not going to walk in and walk out with a check, okay? And so it's going to take time. You've got to build a relationship, okay? And I totally agree. If you think about it as a pitch, you're already making a mistake, because no one likes pitches, okay? No, you like collaborations. Venture capitalists love, I would say, perhaps to an unrealistic extent, to be involved in early stage businesses. It's the same way the quarterback coach sort of feels that when the quarterback's on the field, they're there virtually. Of course, they're not there virtually. And the good people realize that actually there's a line, you're the coach, I'm on the field, I throw, you tell me. Okay, so it's a difference there, but nonetheless, they want to be collaborative, and to the extent that you can involve them, and they can, like all coaches, they can tell you a lot of stuff that's important, you will do a much better job, okay? So it's a very important relationship, very subtle relationship. And the good entrepreneurs work that relationship exceptionally well, okay? And so, but again, you've got to build that over a period of time. It's not something that happens instantaneously, and you're right about that.
And the one thing I would add is that in my experience, some of the best entrepreneurs are not necessarily the easiest to get along with. So this doesn't necessarily mean you're, it's like that, but it's an important relationship, but not necessarily a buddy-buddy relationship.
No, it's not a buddy-buddy relationship. It's a professional relationship, and they got a job to do, and you got a job to do, and that there's a difference there. There's no question about that.
Yeah, just to close off this topic, because I know Steve has other questions. So I actually do think it's important to balance both of these dynamics. If you're talking about a sales and performance pitch aspect to what you're doing, as well as the ability to, with substance, build a relationship over time to tap into someone as cerebral as John is, right? So I think it's an important balance that you need to strike between the two. And both are essential, because a lot of this is also a probability game. A lot of, as John mentioned earlier, the 7 interactions to get to a closed deal, you need to be able to do a good job in that first interaction to convince them to spend time with you in that second and third and fourth interaction. You need to be able to convince other people, in addition to us, your champion, that you deserve to get funded. And a lot of what we watch for here, at least for myself, is I'm watching your interactions with me as a proxy for how you will sell in other situations, whether it's how do you recruit your COO or your CFO, or how do you get that next round of financing? How do you get your first customer? Do you have the persistence or the preparation, the skills to take that substance underlying your business and picking the right things to organize into a sales pitch, and the way that you actually interact with me and make a social, emotional connection with me.
But there's a difference between vision and pitch. So the good guys have a tremendous sense of vision. They know exactly what they want to do. Okay, but the best pitches. So the best pitches I have, didn't involve slides. Well, no, the guy came in and he got a piece of paper and said, "Look, it's like this, and we're going to do this, and we do that." I'm thinking, "Whoa, that's a very clever idea." And said, "Tell me about it." And then for an hour, he doesn't know. He's just telling you. There are no slides. No, it's just.
Absolutely,
yeah. It's him telling you what they're planning to do. And that sense of vision is very important, okay? So, I think there's a temptation here to think that, if only I have McKinsey do my slides, or I had little rabbits that came up, or, I had more video in it, or, there'll be something, and then they'd just roll over and write me a check. It doesn't work, okay? It's, the good guys is the substance here they're going to be looking for. And the only reason a pitch is good is because it helps you communicate the substance. And if you can communicate that substance on the back of a napkin, use the back of a napkin.
I think you get different entrepreneurs than Jeff and I do. We don't often have the back of a napkin, just the app.
Just the app.
Okay, so they're lucky enough to get in the door. They're lucky enough to raise money from you, which is hard to do. Let's face it, about 1% of pitches get funded or less.
Not even.
Less.
Less than that.
So
800 opportunities a year, and we do 5, 6. Yeah, so...
So I'm in rarefied company. I've gotten some money now. After you invest, what do you see either yourselves or others do, other VCs do, that either help or hurt their companies other than writing checks? What's the value add to a VC these days, since there's so much money floating around?
So I think that the most important thing you can do as the coach is to let the entrepreneur know about potholes in the road that they don't know about. The ones they know about, they'll do a pretty good job. And in fact, if they know about the pothole and they don't do a good job, you have another kind of problem, okay? But if it's the ones they don't know about, because they haven't seen everything in business. And so what you can do, particularly if you've been around a long time, is you can help them know about things that they may not have spotted, okay? And I think that's the most important thing.
Which means that you're going to try and understand what the potential potholes are, point it to them, and try and give them the resources and share your experience, access to other people in the portfolio, and then help build the company. At the end of the day, what we do at any stage we get involved at is to build the company for the next level. So our job is to take the companies at seed and help them in any way we can to get them to, go through a Series A.
Help build them.
Yeah, help build them.
Help build them.
Help
You said build.
Well, we help them build.
Yes. Okay. Good.
Generally, I invest with entrepreneurs who know a heck of a lot more about the space than I do, and I offer things here and there, but what I do personally is I just hump it. I'm hustling it to do all that I can to help with the kind of basics, recruiting, networking, introductions. I'll look at I'll do whatever to help these people. I think that it gets to a point where there are some things that you can see. Sorry, I keep on ripping this thing out of my ear. I don't know if you can. I assume you can hear me now. There obviously are some things that you experience that you can share that they don't know. But that's my approach. And NEA, we are a larger firm, so we're a partnership with a lot of resources. A lot of people know a lot of people, so we can actually do some connecting and stuff like that to add value, which is, which comes before any sort of glass house, major strategy session I'm going to provide about the market the company is going after.
Yeah, I'm on the same pace as Pete. I think you invest in entrepreneurs who, at some level, you think aren't going to need you. Like they're going to go figure it out along the way, their own self. One of the CEOs that I invested in is a guy named Al Lieb at ClearSlide, and he was the founding CTO of Evite, and now he's doing this B2B thing. And what he told me the other day, after we've been investors for 2 years and super happy with this company, and he thought, with my background as an engineer coming in, I was going to be all about product and technology. What surprised him is all I talk about is people. All I talk about with him is like, how do we get world-class people at every level in the company, from the executive level all the way down to the receptionist. And he was surprised by that. But in a lot of entrepreneurs, they raise their A and they're like, oh my God, I can't believe this. I'm spending 50% of my time recruiting. Like, it's what wasted time. I want to get back to product. And what I tell them is like, a lot of time when I was running Mozilla, I would spend 80% of my time recruiting. And it's like there's almost nothing more important than getting people in the door that are amazing, and not only can offload entrepreneurs and offload the management team, but actually increase the speed of the business. And so, I don't know, I tend to focus on recruiting and getting people around CEOs and the founders. I tend to focus on how do you build mentor networks and peer networks. I was fortunate that when I was Reid Hoffman and I got introduced by a mutual friend kind of randomly in about 2002, 2003, when he was at PayPal and I was at my startup, and we just started having breakfast. And he would talk about challenges at PayPal, and I would talk about challenges at Reactivity, and then he started LinkedIn, and I probably have 5 or 10 of these relationships where I just go have breakfast with them all the time. And none of them understood all of my business, but they understood, each were able to help me process and synthesize my own business and grow better. So we try to make those connections for our portfolio CEOs now.
Just to, I think I agree with most of what's been said, but one thing that is very core to what we do at Khosla Ventures, in fact, Vinod often calls ourselves not venture capitalists, but venture assistants, is really thinking very systematically about how we can help our entrepreneurs in different areas where perhaps they're less experienced in or less equipped to deal with. We invest very early. We invest in folks who are hopefully the best in their area at X. And that could be, the best at viral loops for this type of sector, or the best scientist for this type of material science, or an individual that is a sales and marketing genius, right? So as a result of investing really early in individuals or groups like that, often they don't come fully baked, right? There's some aspect that they're less experienced with. So often we have to help them incubate and build capability around them. And so I think what John said about recruiting dominating more of my time as a board member than anything else is absolutely true. Whether it's working with a science team that spun out of MIT and trying to find a public company CEO type that'll come in and be their first commercialization wizard, I spend time chasing after people, trying to convince people of the vision, doing that. Or if it's a team that already has a lot of the product building blocks in place, thinking about other markets or other areas where they want to enter. So, for example, China market entry strategy for 2 of my companies, and flying over and helping them negotiate their first joint ventures, because that is a gap in their area until we find someone who could do it better than I can. So we actually take a very hands-on approach. I think finding and assembling the right type of DNA to help the CEOs do what maximize what they're capable of doing. Actually getting our hands dirty with specific aspects of things that really can add a lot of value. And then the idea of coaching and the mentor networks and all of that, I completely resonate with as well. One of the things that we often do at KV with our companies is really help our CEOs think bigger or be willing to take more risk or be willing to fail. I actually, with several of my CEOs, that's actually, some of the coffee chats that we have is really around that. What now that you've gotten a certain amount of traction, how do you think of a product feature that might alienate 20% of your user base, but might increase the size of the community by 5x? You're able to take risk on those types of things. We're spending more money in these areas to run more experiments. And so some of this is a bit of this kind of psychology around motivating our CEOs to really think bigger and take more risk and try some things that they might not otherwise do. And I think that's something that they've found some benefit on. And the last thing I'll mention is that, relative to mentor networks, that's something that we very, very systematically do. Vinod obviously has an incredibly powerful network, and a number of the different partners also in their respective domains of expertise. And so we are very collaborative in the way that we share those resources across all of our portfolio companies, where Bill Gates, who's one of our strategic advisors, will assemble a set of meetings with Bill for companies that we think can really have an incredible amount of benefit from that. And we set that up so that we can facilitate that type of mentoring. And we do that with a lot of the other luminaries that we're fortunate enough to have taken an interest in the stuff that we're doing. So that's what I'll say.
Well, Pete mentioned there was a certain herd instinct in the venture community. We've got a diverse group of companies represented in the audience and come to you. What areas these days are generally considered hot? What's not so hot?
So
and why?
I would like to disagree with that, if I may, and that is that I think over the time we're going to be a lot less sheep out there because the sheep are the guys who have the 0% returns. Okay, so although we don't set out to be mildly contrarian, if you look at what we've done, it ends up being mildly contrarian. We get very uncomfortable investing in fads which we think are short-term in orientation. If your average holding period for an investment is 5 or 6 years, investing in something which is going to be out of date in 5 or 6 months, it works for a day trader, but it doesn't work for our kind of business. So, we tend not to like fads, and there are plenty of people in our business, and I'm sure others, who make money out of fads. But a fad, the problem is that one day, a little boy says, "Well, the emperor's got no clothing." And you lose 98% of the value in 4 minutes. And so that we can't deal with that kind of thing. We have to build real businesses that attract real value over a long period of time. And so we tend to stay away from the sexy things, okay, because of that.
Yeah,
I would
that was
actually
one.
disagree with that.
Sorry, I was well. You can disagree with that, and then after I disagree with that point too.
Okay, good. I'm glad we're not agreeing.
No,
I don't think we're sheep.
No, the original point actually that Pete made, I wanted to jump in there around the herd mentality. So at KV, we don't often, sometimes we don't succeed in this case, but we actively try to think about how we can avoid the herd mentality and how we can be contrarian about the way that we look at different markets, industries, and so forth. For those of you that might have seen the Wall Street Journal article about clean tech, where despite everyone leaning back, pulling back, trying to clean up the craters that have been made, we're still very long on clean tech. The last 3 hires that we've made have, prior to Keith Raboy and Ben Ling, were all in the clean tech area. And that's because a lot of the most talented folks and good thinkers in this area were leaving their firms. And so it's the right time for us to look. Great valuations. The science is still going to be transformative, and energy is a massive industry that's still waiting to be disrupted. And we're in inning 3 of an extra inning game on that. And so for us, we continue to be very long on it. We continue to have multiple partners who are thinking a lot about what that next thing will be. And so that very much is decidedly contrarian. In terms of some of the new markets, we were very early in recent vintage to think about food and agriculture as an important investment area. So we have now done seed investments in ways to disrupt manufacturing around meat, cheese, salt, eggs, candy, and a bunch of other things in the food area where essentially we're trying to recreate the 1,000-year-old method for how you get a steak on your plate, which is you kill some cows, right? So we're trying to use food science and synthetic methods to be able to do that. And so we have now a portfolio of about 8 or 9 companies that all fit in that area, plus another 5 or 6 companies that are trying to use the latest machine learning, machine vision, and robotic techniques to improve agricultural productivity, because that is a huge problem in the world. Another area that we have quietly built up a lot of capability in that now is, I think, a very popular buzz word is around the healthcare area, where looking at the intersection of mobile devices and high-performance computing and health monitoring. So we have quietly built up about 8 to 10 different companies that we've seeded that are all about monitoring different parts of your body and different aspects of your health. One of them is a company called AliveCore, which is a $15,000 EKG machine that's been distilled down to an iPhone case that I can send to my dad, have him after dinner every day run his EKG, and then use the supercomputer called your iPhone to process whether or not there's some anomalous signal and text whoever you need to if there's an emergency, or tell you to go to the emergency room, right? So we've already built up a number of different companies that are hitting that and different types of monitoring techniques. So for us, we're actually trying to, we're trying to be the ones that are starting the herd and not being the ones that are following the herd. And again, we're not always successful there, and sometimes we end up missing some opportunities that cause us to come in later stage when we've missed them, and we're open about it. But we decidedly want to be, again, the leaders of the herd.
Yeah, well, let me just clarify. So I'm not looking for the herd either. And I mean, where we've made really great investments, it's been totally, almost contrarian. I mean, you look at Tableau. Tableau, we invested when open source was the thing. Open source software. The idea of on-premise, closed source software was the furthest thing from the herd, and it turned out to be, one of our most successful investments. So, I totally buy into the contrarian more than anything. I mean, VMware was nothing about people weren't looking for server virtualization. They weren't looking for hypervisors when VMware started. So I'm totally on board with that. There's this thing of playing into trends, which I think is important. I mean, recognizing that some of the themes that are going on and capitalizing on them. VMware was about underutilized x86 CPUs was a massive situation going on in the market. Server sprawl was going on in the market, and they played very nicely into that trend. So I think that recognizing trends and seeing how a product can play into that to speed time to market is very key. But the herd is a bad thing. And my point about my little signaling thing was strictly about signaling. It was not about saying that I'm a big data company. I'm a cloud computing company because that's what everybody's chasing. So let me just clarify that. I think that we all would agree that it's the companies that are going to be the most successful 5 to 8 years from now are going to be those with ideas that we're not talking about right now. They're new concepts that play into trends with things that people that are much smarter, that have much better insights than any of the five of us here have.
And the point I wanted to make about the herd is that there's always like the latest fad in VC that seems to always get the buzz and the funding, and whether it's Bitcoin, whether it's 3D printing, whether it's a couple of years ago it was flash sale sites or daily deals, and so all those things sort of have come and gone, and some companies actually were built and were successful, and the rest was just washed out. And what you have to understand is that if you look at a given space and the curve of exits, whoever is the first or the largest exit sort of happens very often at the beginning and gets certain value, and then from there on, the number 2 gets half the value, number 3 gets a fourth of the value, and so on and so forth. So you really want to invest in number 1 because that's where you make the money.
And number 1 is when it's not a fad, because it hasn't yet started. That's my point. By the time people are talking about it, you're down to company number 5 or 6. And then it's much less interesting.
Well, I'm not sure I agree with that. So I think that there are many companies that get to scale that are not first, or not second, not third. I think PhotoShare. So look, I mean, like you put Elon Musk on stage at D, and you're like, well, shit, we should all be working on electric cars and spaceships and important problems. But like, maybe I'm a simple cat, but like, the fact that I can video conference with my 1-year-old son on his birthday and my mom,
right?
That's pretty transformative, and it's not complicated.
Skype made a lot of money.
Skype did, but so did Instagram, and so did any number of the way Facebook and the way we communicate, the way we talk with each other, the way we communicate with each other. And so what I would say is there's a bunch of technology waves that are happening that are massive, massive, massive.
Right.
Like we all carry these tiny computers around, and that's transformative in every single case. And in a lot of times, it's going to be, well, shit, somebody already did this business, but we're going to do it in a way that's mobile, or we're going to do it we're going to do photo sharing, and you're like, well, for fuck's sake, another photo sharing company. But like, you're going to do it in a way that, like Snapchat was a good example of a photo sharing company that just did it differently. And they were not first, they were not second, they were not third,
but they were different.
Some. Yeah. I would say they're not as different as Tesla is to the car industry.
but they're different. They had a different strategy. Okay,
so I don't think first matters. I think that being really good and figuring out a way to make a really intentional connection with your customer, whether it's an enterprise or consumer.
How about international? China, India have gotten a lot of press lately. For a while, it was very in vogue to open up international offices. That seems to have quieted down a little bit lately. Well, what are you seeing, good and bad, about India, China, and other international hosts?
So Pete and I will differ here. So I'm actually on the board of a Japanese company, and we have done a certain amount in Asia, but not very much. And I would say that we have a lot of risk in our business. There's just inherently in the drug development business a lot of risk. So you add on that the additional risks you get operating in Asia, which is an IP system which is not very effective. The whole legal infrastructure there is not very effective. And I'm amazed. We spend a lot of time dealing. We have companies in Norway and Sweden and Belgium and a lot of places in Europe, and the legal systems there are very different, and so we know arcane information about Norwegian stock exchange law and Belgian stock option law and things like that. And so, when we go into a place, we're looking at what the legal infrastructure is, and I would say it's not very good. And so, because of that, investment rights, intellectual property rights, we have invested in a public Hong Kong-listed Chinese company, but with that exception, I think we'd be very nervous about investing in a private Chinese company. He's going to differ.
Well, I mean, we have partners on the ground in China and India, and there's plenty of opportunity there. I think that we've scaled back a little bit, certainly due to some of the liquidity environments in India specifically. And in China, we still see a lot of great opportunity with some of the government divesting in some of these sectors, deregulation, some of the healthcare dynamics in China. We're actively investing, and I'd say maybe it's come down a little bit given the liquidity. But we still have partners on the ground there and see opportunities to make money for sure. And this goes back to the strategy of our firm, which is kind of looking at how we allocate our capital on a very relatively granular basis. And we're going to watch it and increase investment as we see opportunities open up. But I think that, relative to 2-3 years ago, it's come down a little bit, but that doesn't mean it's not going to come back.
So by virtue of being the only Chinese guy among my partners until Ben Ling just joined, I'm the China guy naturally, and so it's kind of hard to ignore. It's kind of hard to ignore a country like whether it's China or India, where so much is changing that an everyday type of business industry that's incredibly mature here is growing at 50 to 100 to 500% per annum. Right, where you can potentially make significant returns either as an entrepreneur or an investor across so many disparate types of industries. So it's hard to ignore the place, but I have to also look at my limitations. I don't have a ground team there. I have not hired local partners there. I'm going to be out-diligenced and out-negotiated by a lot of the local folks there if I try to do a lot of local investment. So I'm going to play to my strengths. And what is that? I've got what I think is probably the largest portfolio of early stage technology, whether it's in the clean tech area or food, agriculture, a lot of these things that are very fundamental to their existence. They have a survival driven demand for more energy, more food, more agriculture, and better connectivity and so forth. So for me, my first step in thinking about a place like China, India, is how can I take the technology that has the best fit there and do some sort of technology transfer and help facilitate relationships out in China or India to help my portfolio companies that may have started here in New Zealand, in Europe, or wherever. And so that's really kind of step one in probably a maybe a 10-year strategy, I don't know, where I want to be able to create some wins to show that I can create incredible technology wins through my portfolio, through my existing technology in places like that. And we've been able to see some early examples of that. I'm on the board of the two clean tech companies that I mentioned earlier. Both of them hit their heads against the wall in the U.S., both in terms of fundraising, developing partnerships. But in China, because the Chinese government has pledged $80 billion a year for each of the next 10 years into clean tech, I've been able to get significant traction where we help negotiate 2 joint ventures where they will invest more than $200 million to build our first plants to commercialize. So it will commercialize first in China with 0 capex from us, clean tech done right. So again, it's sort of hard to ignore these countries, but there are so many dangers and perils that I think Jonathan mentioned earlier that you really do have to tread carefully, and it's not just about dropping a team in there and starting to shoot some bullets to hopefully make some returns. We're taking perhaps a slightly more conservative approach, but one that plays to our strengths.
Okay, thanks. We're opening it up to audience Q&A. So for those of you who've been waiting to ask a question, we've got roving mics around, so just raise your hand and get attention, and whoever gets the mic first starts. We have a winner.
Hi. Brian Bulkowski, Aerospike. We recently were funded by NEA.
Was this a plant?
No. But the one thing that in the beginning of your talk that resonated with me so much as a beginning entrepreneur was sales. And the one thing that my greatest unknown, given that I read a lot, great technologist, business school, all that stuff, I did not know how much I did not know about sales. So I would be interested in hearing from you guys, how are you supposed to learn this? It's not taught in school. There's no classes in it. There's no high school in it. Debate is counterproductive. You guys all just talked about how great sales is. What's your recommendation for people to learn?
So the most important thing you said is you didn't know how much you didn't know.
Well, now I know that.
So I think one of the things that you do in this collaboration is to try to let an entrepreneur know there are things that they don't know, okay, and get them to go, because once they know that there's stuff out there in the jungle they don't know about, okay, there are ways to address that problem. I would say the biggest problem is people who don't know they don't know, and then they just get blindsided, and then and that can be really bad, okay, and so. I think that's the most important aspect.
There's two elements. There's sales as in closing the deal with the customer yourself, and there is managing a sales organization as a CEO and growing a sales organization. They're just different beasts. And I think that when it comes to selling yourself, I was a sales guy early in my career. I took a sales class, and I referenced that sales class about kind of the techniques to close. So I actually did learn something from stuff that you can read, but I think along that line, I think the biggest thing that I would point to is just listening effectively, really understanding the customer, reading the customer, and that's what I would advise somebody who's getting into sales for the first time. I think with respect to the sales management function, which I think in the position you're in, certainly that's probably the bigger issue, because you're going to be hiring salespeople. How much are these guys sandbagging? How much are they? What's Oh, and that's not good. That's not good. All right. Well, we'll have to talk about that. But with respect to sales management, I think that this is something actually where the venture investor Katu or Rohini should be able to help you in creating the plan, sizing if they're sandbagging, what their comp levels are. So there are some orchestration around sales management, which actually I would like to think that the venture investor can help you with. Right. If they have experience there. So, but when it comes to closing the deal, I think it's listening well, persistence, and there's some certain techniques that just come with time. But I think listening, I think it's the one thing that you can't overemphasize. Really reading the customer.
Preparation, understanding the customer before you get there. That's half the battle.
What I'd say is all this stuff is true, but like most of you just need to go do it. So I'm a computer scientist by background, and I'm like one of my favorite jokes is Mitch Capor told me, it's like, how do you tell the difference between an introverted engineer and an extroverted engineer? Well, the extroverted engineer looks at your shoes when they talk to you. And and so it's and I'm one of them. So I'm saying it out of 100% love, because I do that too. And I think the first 5 CEOs that I funded were all computer scientists. One from MIT, 3 from Stanford, 1 dropped out of high school. And I recognize this. Introversion is hard, and it's hard to get out and sell. And so I think that a lot of times what you have to do is say, well, I need to understand what that's about. And so I'm just going to go put myself into situations that are uncomfortable for me, and I'm just going to go ask for the order. I'm going to ask for the order in ways that make it seem ridiculous. I'm going to ask for a ridiculous amount of money, or a ridiculous contract, or a ridiculous commitment, or a ridiculous term. And I'm just going to see how it goes. And I'm going to learn after that. And I think that you have to be more committed to winning than to feeling comfortable, and that's sort of the key.
Yeah, I think I really agree with what John just said. Although that joke was awesome, I'm going to use that at some point. So part of it is the repetition, because one of my mentors in the past told me that the thing about really great salespeople is that they have this amazing level of pattern recognition, where when they walk into a sales situation, they'll know what psychographic profile this person is. They'll know in that company situation what types of things will generate that emotional connection, and what are all the things that enhance his probability of getting that next meeting or getting the call back, right? And that comes from just repetition, pattern recognition. It comes from the mistakes that you've made and learning and dissecting why the thing didn't work out and getting the right type of feedback around that. So I think nothing beats having that kind of repetition. That being said, I'd say that a lot of the best sales folks that I've known have all been able to point to people that they really learned a lot from in terms of watching. So whether it's finding the right board member or mentor that can really walk you through some of these situations and again dissect the way that you had interacted with a customer and how that worked out, to having someone or working with someone very directly that has that type of sales skill. I think that type of mentor apprenticeship model is really a good way to learn it, short of you just putting yourself out there and doing it again and again and again until you find that rhythm and that pattern.
Okay, we're going to switch. Where's the microphone over here?
Hi, yes. Thanks for introducing. Great speech. I really enjoyed it. I'm Alan Hughes. I'm the CFO of Carrier Technologies. We're a software company in San Jose. My question was this. When you're talking about Series A funding, a number of you mentioned things such as sell yourself or the entrepreneur, suggesting that the startup is just one guy and a great idea in a garage. What happens to the situation if those great ideas are evolved in existing companies, profitable companies, been running a number of years, where suddenly they come up with a great idea that screens the VC? Do you feel that, in fact, they have to spin off that so they're a separate entity to interest you guys? Would they have to do that prior to seeing you or as part of the discussions with you?
I think spinning it off is going to be the way to maintain the right focus. Okay, and I think you can structure it then much more effectively. But it doesn't have to be structured by the time you come and meet. So we've done a fair amount of spin-offs in our time, and people come to us and say that we've got an idea, we want to spin this off, and then we talk to them about the idea and how you spin it off. So, I think getting venture capitalists involved early in that process is always a good idea.
Have you ever had a situation where you get existing companies looking for Series A funding because they got a great idea within that company?
We've had that happen within our own portfolio, where one of our companies has a broad set of intellectual property, and there are a couple of ideas that are a bit orthogonal, either market-wise or product-wise, from the original focus of the company, and we've spun it off. So we've had many examples of that type of thing happening. Yeah. Whether they're spin-offs from large companies or from labs or from universities, I think for many of the folks who have invested at the early stages in that type of context, it's not an uncommon thing to do. I think the main thing is how clean of a spin out it can be. So the more entanglements, the more complications, the more that the parent company wants to have hooks in the strategic direction, or maybe have some of the development ultimately benefit them, or that's where I think early stage VCs will get a bit skittish, because they tend to want to have that type of independence. And if we're going to put in all this equity in this early level of guidance, we want to make sure that there's no artificial limitation right at the beginning that can cap the upside of the opportunity.
Thank you.
Okay, we're going to flip back over to the other side. I think you got the mic right here.
Hi, thanks for spending your evening with us. I'm Linda Olson. I'm a medical device entrepreneur, and I took advantage of the California Qualified Small Business Stock Incentive Benefit after a company sale in 2008. And because of a move by the Franchise Tax Board, I now have to write a retroactive tax check for $60,000. And another entrepreneur I know has to write a retroactive personal tax check for $600,000. So we're fighting this at the legislative level, but it's just interesting to see the political shift towards a more and more hostile small business environment. And I wonder if anyone on the panel can speak to that issue of small business startups going forward. Thank you.
Yeah, if we had someone from the MVCA here, I think they would be, very, very supportive. We live in an environment where, people do not understand the job growth that traditionally has come out of small businesses, and we're now in a situation where we're curtailing that job growth. And I think one of the reasons we are is that there's less risk capital available, so that's one aspect to it. I think there's a lot more regulation. I think that's another aspect to it. And I think the tax structure is not optimal for doing that. And I think that, I think politicians, unfortunately, are not very familiar with that. And that's got to do with the way they spend their time, okay? Large organizations can afford to have people in Washington full-time advocating for them, okay? And so that's who a politician sees. They see lots of large companies. They don't spend time with small companies, okay? And so that's a real problem we have politically in this country.
So Jonathan, you only do life science. FDA has had a lot of issues in the last handful of years. Do you see those issues getting better, worse, or about the same?
I don't. So people like to assume that this is really the FDA, and of course, the FDA is responsive to its boss in Congress, and Congress really is much more focused on the growth of healthcare costs, and that's what they fixate on, and they want that to grow slowly. And one way to grow it slowly is to slow down the rate of innovation. And the best way to slow down the rate of innovation is to encourage the FDA to be ridiculously tight about new things. Okay, and so that has some very beneficial things in terms of future healthcare costs. Now, the fact that it's going to give everybody, a crappy life expectancy in the U.S. and we'll all have to move to Sweden is not an issue. Okay, so that doesn't work very well. They don't really care about innovation when it comes down to it. Now, interestingly, they do care about jobs. And I think that the people who are sort of our friends, Eric Paulson, for example, who's a congressman from Minneapolis, has 300 medical device and biotech companies in his district. And, he got the entire Minnesota delegation, Republican and Democrat, to write a letter to the FDA saying, you're going to lead to the export of tens of thousands of jobs. Okay, and these are not, burger flipping jobs. These are, interesting high-paid jobs which are generating a huge amount of GMP. So I don't know. I mean, maybe that'll have an effect. But right now, I would say that the whole healthcare system in the U.S. is skewed against innovation. Okay, and that over time with reimbursement is going to be skewed more against innovation.
Yeah, and maybe broadening the picture beyond the healthcare space, because we actually do a bit on the kind of DC, linking Silicon Valley to the political sphere. And I'd say that beyond whether it's in healthcare or energy or in education or just general small business, there has been something lost in focusing on fundamental research, small business job creation, and starting that innovation engine. Because as I think Jonathan pointed out, a lot of the folks who have the lobbying capital are part of these large institutions that frankly don't want to get things shaken up. They don't want a small startup company from Silicon Valley blowing their industry up, right? Which is a lot of what we try to invest in. So it's unfortunately a big push or pull. And so I think President Obama is at Vinod's house, and he has spent time with him talking through different plights of the entrepreneur in hopes of motivating a bit more change in that area. And I'm actually in DC next week talking to their head of climate, Obama's chief advisor for climate change, to talk through different policy and regulatory things that really can help startup companies actually commercialize technology in the US versus me having to go to China and negotiate a deal so that my first plant goes up there. And so there's a whole string of things we could have an entire panel just to talk about how more of what you folks do as citizens in terms of what you do writing to your congressmen and women about what they can do to help small businesses start the innovation, tax breaks for the small businesses, and having the government create more types of grant money to help fund early stage companies, fundamental research in life sciences or energy. There's definitely a lot of that, and frankly, it's a bit sad to see because I can see progressive policies around the world that are doing the reverse.
Okay, flip to this side.
Keith Lyons, Lens Consulting. I didn't think we were going to have all these healthcare questions. It's great. But my question, there we are. My question was simply what the division among your portfolio companies is between, if you divided healthcare investments into three big blocks, biotech being one, drugs, medical devices, and downstream healthcare delivery, things that run on iPhones like the LifeCore, that sort of thing. Is there a trend? What do you see going forward as the current split of investments percentage-wise?
Well, we're doing a lot less medical devices than we used to, that's for sure. And the ones we do all their clinical trial work in Europe, because they get a CE mark and away they go. So it has really become, that's an area where, and I would say generally, if you look at the medical device, those venture capital firms who specialize in medical devices, Three Arch and De Novo, and they have really had the what's it kicked out of them. So it's just, I think the medical device area is right now under enormous pressure. Another area that's under pressure is diagnostics, okay, under enormous pressure. Predictive Science went bankrupt, earlier this week. They have a code to get reimbursed under, but the payer decided not to continue coverage. So you have a reimbursement system here which is very unstable. And so I think both diagnostics and devices have become a lot more problematic for us. Not that we won't do them, but we're just a lot more careful about it. Drugs, I think that our view is that early stage drug development is interesting and very, very late stage drug development is interesting, but do not get trapped in the middle, okay? That turns out to be a desert, okay? So that's generally our perspective.
We would probably, of our healthcare investing practice, I bet you 80% of the dollars are going into the pharma
in drugs
area.
Yeah.
I would say, and I'd say the other, 50. I mean, maybe it's 70%, but with Tesaro, the recent success of the public markets, I think it's going up, and that's funny how things work that way. And then the smallest amount is in the devices, and maybe twice devices is in the service and the drug delivery area.
The answer for us is simple. We are 100% focused on different technologies, platforms that essentially reduce the need for you to go to your doctor. So, whether it's a lot of the monitoring things or something like HealthTap or whatnot, it's all about using technology to its fullest, and a lot of the machine learning and big data type of approaches to empowering you, the consumer, to take matters into your own hands and either prevent future problems or solve them before you need to go to a doctor or need to seek some more specialist help.
Okay, we're going to flip over here, and wherever the roving microphone people are, if we could go back and forth, it seems like we've given a monopoly to the front of the room here.
Sorry. Dave Nelson-Gallup from Viacog. Thanks. This is very interesting. One of our challenges, we're a brand new company, bootstrapped ourselves 3 months ago. My partners, I've been in a couple of companies where my partners are deathly afraid of VCs, They don't want to take that early round investment too soon and get diluted or squeezed or manipulated or whatever. There's a fear of VCs amongst several of my peers.
We're glad you're able to face your fears tonight.
Yes. Do you want
to come up on stage?
Yeah. Start selling.
There's also this notion of, well, you got to go through all these pitches, but you only get one chance to kind of do your pitch or whatever. You have to go through pitches to get your charisma skills up to snuff or whatever. What would you say to new entrepreneurs, new business ventures that are just afraid of you guys, of getting you too early? I like, John, your point about being a mentor, but how do you really kind of bridge that gap between?
So I think the first question you have to ask yourself is, do you want to create a small business or do you want to create a large business? Because there are plenty of mom-and-pop operations that never go near venture capital firms and grow slowly and reinvest the capital and don't need a lot of funding and grow modestly for a long period of time. So if you want to be a small business, I know. Now, if you want to be a large business, okay, it's very hard to construct a model where you can do that without getting a lot of capital in to create that runway. And I meet people who have the same reaction. They're very frightened about coming, or they want a time when they come, okay? And I would say the following, that is, we've had people who try to stay away for 3 years and then come to us and did angel funding and all that sort of thing. And then they come, and it's like those greenhouses where you have some plant that's like this. It's just, my God, if we're going to create a 110-floor skyscraper, you can't do it on a base like this, So you have to, you enormous amount of rearranging the furniture in order to get the thing to the point where you can go up. So I think if you want to grow a large business, the sooner you get involved with the people who can help you grow that business to be a large business, the better off you're going to be. Now, is there a risk associated with that? Yes, there is a risk, and it's the following risk. If you aren't the kind of people who are flexible enough to grow with a large business, then that's going to be a problem, because you have to be flexible if you're going to grow large businesses. And some people, when it comes down to it, they aren't that flexible. And actually, they'd be happy to have a small business that they controlled than a large business that they owned a piece of. So it's really a choice of, do you want to be a small business or do you want to be a large business, I think.
So I kind of reject that thinking. I think that there are plenty of big businesses that grew without venture capital. There are plenty of small businesses, very small businesses that had plenty of venture capital.
That are getting smaller.
And getting smaller.
Yeah.
Can't get any smaller than
I wouldn't
some
say
of them.
they're successful.
And so what I would say is, you've already taken the massive leap, which you said, fuck it, I'm going to go start a company. And so you've already decided you're going to reject a bunch of the frames that other people have set for you. And so what you need to do is figure out what business you want to build, and then figure out how to construct it. And sometimes you need capital and money. Sometimes you need help. Sometimes you need. I actually don't think of venture. I don't think VCs in general are the best mentors in the world. I think they're often good partners for you. And I don't think in my answer I said I thought of myself as a mentor to entrepreneurs. I think that I try to help them the best I can, and I try to connect them with other mentor networks. But you figure it out from first principles, like you're doing everything else in your business. Figure out what your business needs. Figure out whether it needs capital, whether it needs help, whether it needs regulatory, whether it needs a place to sit, all this stuff, and then go do that. I think that the other thing I would caution you about is, like, there's no such, like, VCs are not really a class. Like all five of us, you can tell from the way we talk, are super different in what we do day to day, super different in how we interact with our, I text with my startups with one of my message me CEO all day long because he runs a messaging company. Like some of my partners would never ever text with their CEOs, and it's you just got to figure out who it is that you need help from, and not worry about classes. Like, because I don't think VCs as a class is a helpful.
And the other thing is, we wouldn't be. What I would tell your employee or partner is that we wouldn't be in business for a long period of time if we weren't in it to make you successful, right? So, it's not a vulture capitalist thing. I mean, we're here to make we win when you win. For firms that have been around as long as the firms around here, that's right. the deal. That's the deal. So we want, that's where you have to have your act together for that first meeting, because you can't screw the pooch in the first meeting if you don't have your act together. Fact. But it's a partnership, and we wouldn't be around as long as we are, as successful we are, if that wasn't what the deal is.
And one thing about that, one thing about that is that, again, very different, the five of us. There's homework that you can do about different firms and different people within firms to know whether or not you might want to work with them and wouldn't be afraid of them, right? And entrepreneurs like to talk about it. And actually, to give John a bit of kudos, over the last couple of weeks, I've heard from multiple entrepreneurs specifically about how they enjoyed their interactions with John, right? And so I think this is the type of thing where you can, if there is some sort of weird fear, man, I'm going to give up a certain amount of my company to do this, but okay, I've decided I need capital. I want to build something greater than a lifestyle business. And so what do I do and where do I go? Find out about the different firms and the different people, and go through your networks to see who knows what people, and you'll get a sense for whether or not these people are interesting enough for you to date, right?
So here's an interesting data point, which is, and you may not know this, which is our limited partners grade us. So I'm now, I get graded every few years. I got to raise a fund, I get graded, okay? And so they will go to repeat entrepreneurs and say, what was it like interacting with this individual? And so, I have apparently a very high score because people want to continue. They do one company, they come back, do another company, okay? They had 6 or 7 venture capitalists they could have gone to, but they said, no, I want to go to him, okay? He was the most useful guy. So, we can't be in business here in a way where we're driving deal flow away from us, okay? Because we're not collaborative in the approach we take. Does that make sense? Yeah.
Steve, how about throwing a bone to the back?
We're trying to move the microphone. We've got one here, and then we got some very persistent people that are going to lose blood flow in their arms if they don't get a microphone there.
Hi, my name is Neha Ajmer. I work for McKinsey, by the way, so thank you for the comments on our slide making.
Excellent.
That wasn't positive, I think.
I used to work at Bain. It's okay.
Well, there
Don't
you
worry.
go. Well, that's
I actually worked at BCG, so I only did it for
We're in great company. So the question I had was, and early on you talked about, the whole pitch framework, and we don't want to see slides. That doesn't really make the case, etc. And I see that and I believe that. But there's also this environment in the Valley these days of all of these pitch-offs, variety of different disrupt platforms where apparently entrepreneurs go and they have, the 10 minutes in the spotlight to talk about their ideas. And I'm just curious about what you think of the value of those stages is. Do you personally go there? And should entrepreneurs be thinking about that a lot?
So I occasionally go to those.
I bet Jeff goes to most of them.
So, I think if you can actually get the pitch even to work for you for launch, I think it can be actually pretty valuable because you always have a bunch of, journalists, media in the room, and so as long as you orchestrate, the appearance, it can really work. As a fundraising opportunity, I don't buy it because most of the people who have actually been winning those events, they were already funded by some of the judges.
Exactly. It's good practice. I think one of the things, somebody said it before, that it's practice is always good. And I think if you go to those things and you practice telling people about your ideas, it'll improve the way you tell people about your ideas. So that's good.
I think that guy wants.
So we got rapid fire. So I think we got probably time for two more. It's a quick question, quick answer. There and then there.
So I'm going to ask a question in two parts. What's your experience or advice for experienced entrepreneurs? So, those of us who have been in startups before or been in large companies. So what challenges do you face in working with such entrepreneurs? And the second part to that question is, half our team is 20 plus and half our team is pushing 50. So what kind of challenges or opportunities do you see in teams like that?
So if you're an experienced entrepreneur, the first thing that I'm going to be thinking about is how much of what you've done in the past will help you or hold you back, right? So when I was in my prior firm, Lightspeed, one of the guys there used to always talk about how all of his best companies were the ones where they were first-time CEOs who were founding, went all the way, and took it because there's lack of fear. They are hungry. They've never been bound by convention all the way, right? So if you're an experienced entrepreneur, I think that's the main thing that I would be pushing you on is how do you take more risk? How do you be more willing to fail? How do you leverage the things that you learn from your past successes to make it work? Your second question about the 20-somethings and the 50-somethings, I love it. Okay. So for me, we often get teams that are either really early, young, kind of inexperienced people, or we get really experienced people who have worked in industry for a long time and worked 20 years together and whatnot. And one of the important exercises we do with a lot of our companies is this thing called gene pool engineering. It's on our website. There's a paper on it where we try to look at the DNA of a company and slice it multiple different ways to see if there's genetic diversity across 5 different dimensions, right? And one of them is age, because again, you have experience that helps kind of guide you on course, but you also have young people who aren't bound by convention, who aren't bound by traditional thinking, right? So I think that mix is actually a very good thing, and I think that type of diversity often is helpful for breakthrough companies.
Thanks.
Okay, we got one last question and a quick answer.
Sure. I did lose blood flow, but I'm persistent.
Good.
Eitan Ilon, Global Tech. I thought you guys made some really helpful comments tonight, and it wasn't just a run-of-the-mill panel, so thank you. I had 2 quick questions for you. One, what kinds of tools, whether it's techniques, whether it's subscription services do you use to track the market of startups, to track the market of people out there working on great ideas? Number 1. Number 2, how do each of you keep yourselves fresh? How do you step out of your daily routine so that you don't just become numb to the interesting patterns that surface?
That's a great question. I think the spending time with entrepreneurs who are working on things which might not be directly relevant to our day-to-day investing, but have what might seem crazy ideas, but really sort of big vision is the way to keep fresh. Every now and then we hang out at conferences. VCs do a lot of conferencing, thing. In terms of tools, there are a few subscription services that we use for news or databases, but it's really not what keeps us fresh. What keeps us fresh is the deal flow we get. Daily we get, tens of opportunities from entrepreneurs who want to do something small, something medium, or something really big. And we read those and we sort of keep track of trends that way by figuring out what are the main things that end up in our inbox.
You know, you learn the most from meeting with the companies. I mean, that's how you get a sense for what's going on out there. And the more meetings you take, the more you pick up on trends. And when you've got a full portfolio, you pick up the subtleties about where the market's going from your portfolio company. So the reality is that's the most effective, kind of the most concentrated data insight into where the market is headed, way more than anything you can read on the internet. And that's in my personal experience, that's how it goes.
I'll tell you, I think the hardest thing about the job for me is having pitched and having been an entrepreneur and raised money myself, is that I say no. So every day I say no 5 or 10 times. And at some level, you're right. It's an insightful question to ask. It's a bit of a grind. You get a little bit jaded and jaundiced. But the thing that fixes it is you find the one you like. And like when you find the entrepreneur you like, it's like a lightning bolt. And like you're like, holy shit! Like I've got to go get this person and convince this person that I'm going to be helpful and get to be part of this journey for a little while. And when that happens, everything's okay, and better than okay, and it makes up for all the rest. But you can get a little bit cynical, but then you find the one, and then you're not cynical anymore.
The thing for me about keeping things fresh, and I mentioned at the beginning, I'm a bit schizophrenic, and Vinod is even more schizophrenic than me in terms of different areas that we like to look at. And I think that by nature keeps things fresh, but also how we find linkages among different industries, how learning from one portfolio company in one sector can really benefit something that's completely different, but yet that business principle or that way to go to market might really benefit them. That's one of the things that, at least for me, helps keep me fresh now as an investor. And when I was an entrepreneur back in the day, one of the things that kind of kept me fresh, that's a similar idea, is how do I look at successful entrepreneurs or people who are in completely different disciplines from what I do, and what were some of the factors that really changed the game for them or really made a difference for them, and then how do I apply it to my own business? And that was actually a really fun exercise, because if you just read the industry rags about everything that's just in your world, it can get kind of frustrating and boring at times.
I think the thing that I find most exciting is to work with capable entrepreneurs, and they come in with an idea that they're thinking about. And they haven't worked out exactly, the clay is still a bit wet, and to help them understand that actually it wouldn't be so useful like this, but it would be more useful like that, okay? And so that creativity is just enormous fun right at the beginning of a company, helping them, with the vision of what they're going to do. That's a very stimulating kind of thing.
Well, Karen will come up with some closing remarks, but I want to thank the panel for their great comments, and thank the audience. Great answer.
Thank you all very, very much for sharing your perspectives with us so candidly. That means a lot. Hope that you had a wonderful evening as well. As a small token of our appreciation, we have for you the Churchill Club Speaker T-shirt. Yeah, not a onesie. Please wear that in good health. Thank you again to Microsoft and to Womble. This has been videotaped and will be available on the Churchill Club YouTube channel within a couple of days. And you have been a wonderful audience. Thank you so much. Hope to see you soon. Good night.